Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph Show. Had a very interesting meeting this week with a client, and it involved an IRA, an individual retirement account that was inherited by a person other than a spouse. So I thought this would be a really great topic to talk about on the show. So if you've recently inherited an individual retirement account or IRA from someone other than your spouse, you may be wondering, what do you do with the funds in the IRA and what tax consequences there are? There are certain rules you should be aware of relating to title transfers, distributions, and taxation of funds in an IRA you have inherited. There are significant negative tax consequences if certain rules are not followed. It is important to note that the rules discussed, as we're talking about, are only for non-spousal IRAs. There are certainly different rules for IRAs inherited by a spouse. So let's talk about what is an inherited IRA. The rules governing inherited IRAs differ from the rules that govern IRAs having a surviving spouse as a beneficiary. We talked about that. So upon the death of an IRA owner, ownership of the IRA passes to a beneficiary or beneficiaries whom the owner has designated in accordance with the terms of the RA. If a beneficiary is not the owner's surviving spouse, the IRA is treated as an inherited IRA. So there we go. So that's the basic definition. So at the time of death, if you're listed as a beneficiary of someone's IRA and you are not their spouse, then it's going to be treated as an inherited IRA. Now, inherited IRAs cannot accept rollover contributions from other IRAs, and likewise, distributions from inherited IRAs cannot be rolled over. One of the big things you need to make sure of is if you inherit an IRA, and some brokers mess this up, or some banks if you set up this account, make sure you keep those funds segregated. Set up a separate inherited IRA. Now, inherited IRA assets may be transferred in a direct trustee-to-trustee transfer so long as the IRA into which the amounts are being moved was previously established and maintained in the name of a deceased IRA owner for the benefit of you as the beneficiary. So again, it's really important that you set up a separate IRA called an inherited IRA account because you do not want to commingle these funds with your other IRA funds. And the reason that is because of the thing we're going to talk about next, and that's required distributions. You generally will not have to pay federal income tax on the assets in the inherited IRA until you begin receiving distributions from the account. Again, IRA, the person who set up this IRA put this money in pre-tax. So therefore, the IRS is going to be looking to collect tax, but all the inherited IRAs, whether traditional or Roth IRA, are subject to annual required minimum distributions. You may have heard of this called the RMD. The rules are complicated, and you should talk with your tax advisor before taking any distributions from an inherited IRA. And I see this as a problem so many times. Clients will come into me after they've inherited an IRA, and they didn't realize what their rights and obligations were. So it's really important that you do that. The outline of the distribution rules that we're going to talk about are just an outline. The details of the particular situation are crucial to some situations left out for the sake of brevity. In general, beneficiaries of inherited IRAs must receive required distributions over their life expectancy or within 5 years after the original IRA owner's death. Now, these rules get tricky and generally depend in part on whether the original IRA owner died before the date on which he or she was required to begin taking distributions from the IRA. I told you this wasn't simple. This is not simple. So what we're talking about here is if the original account holder generally must begin taking required minimum distributions after reaching the age 70 and a half. So if the person dies, when an IRA owner dies before the date on which he or she is required to begin taking annual distributions from the traditional IRA, the entire IRA must generally be distributed in accordance with either the 5-year rule, which requires that the entire interest be distributed within 5 years of the original owner's death, or life expectancy rule. The life expectancy rule requires that any part of the inherited IRA must be distributed beginning on or before December 31st of the year immediately following the calendar year in which the original IRA owner died, over the life of the beneficiary, over a period not extending beyond the beneficiary's life expectancy. Now, if the individual for whom the IRA was maintained dies on or after his or her required beginning date, so if they pass away after they've already been collecting RMDs, the remaining assets in the IRA must be distributed at least as rapidly as under the method of distribution being used as of the date of death. So, in other words, let's say your grandmother passes away and she's 74 years old. So she's already collecting these required minimum distributions. So you're going to have to take those distributions at least as rapidly as under the method being used by your grandmother. In general, the applicable distribution period is either the longer of the life expectancy of the designated beneficiary or the IRA owner. Annual distributions are based on the beneficiary's life expectancy using IRS tables and the beneficiary's age in the year following the year of the IRS owner's death. So that's where it gets complicated. Now, let's talk about inherited Roth IRAs. The entire interest in a Roth IRA must be distributed under the 5-year rule unless the interest is payable to a designated beneficiary over a period not greater than the beneficiary's life expectancy, and such distributions commence before the end of the calendar year following the year of the death. However, qualified distributions from a Roth IRA are not taxable to the recipient. Qualified distributions from a Roth IRA generally means that those payments made after a 5-year period following the inception of the account and the participant has reached age 59 and a half or died. Now, taking distributions from your inherited IRA over your life expectancy as opposed to a lump sum distribution from the IRA enables you to continue to grow the assets in the inherited IRA tax deferred. That's the benefit to the Roth. A lump sum payment, however, may be requested, but the amount may put you in a higher tax bracket for the year. As you may observe, these rules are complex, but nevertheless, decisions have to be made. Now, all of this involves federal tax consequence. Distributions from inherited traditional IRAs are taxable to the beneficiary as ordinary income. Beneficiaries of a traditional IRA must include in their gross income any taxable distributions they receive. If they do not withdraw a required minimum distribution in any tax year, the amount is still subject to federal income tax. But there's also a 50% penalty for not taking those distributions. Now, we had some ability to get those waived, so it's not you just need to make sure that you're communicating with your broker. Now, like I said before, there's a ton of rules and tax consequences that result from inheriting an IRA. Don't just talk to the financial house that calls you. You need to consult with an attorney. You need to consult with an accountant or a tax person, and make sure that you are structuring this in such a way that you don't cause yourself a big tax problem. Because I have seen in so many cases where a person will inherit an IRA and they don't understand, their grandmother left them an IRA worth $100,000, and they think, okay, well, I've got to take that money out of there. And the problem is that puts them into a much higher tax bracket in the year that they take that money out. So what you're able to do at a bare minimum likely is take it over 5 years. So you cut that income into 5 separate pieces so that you're not pushing all that income into one tax year. So I hope this was helpful talking about inherited IRAs by a non-spouse. Again, a very specific area, but do consult with your accountant or tax advisor before you make any movements in this area.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.